Alright, we have a bit of a different video today. So we're going to be looking at a Japanese nano cap. So a very, very small company. Obviously, we'll get into the numbers in a bit. But essentially, the theme here is one of a deep value play rather than, say, a long term growth stock or a quarterly trade like I normally do. This one's, based on the balance sheet of the company. So, obviously, using my accounting background. But effectively, the company then is called Miraial Co Limited. And so, it's a Japanese deep value setup where the floor is hard, the catalysts are governance driven, and then the weight is paid for, aka it pays a 4% dividend yield. 41% then a net cash on the balance sheet, a zero point 0.5 price to book ratio, and then the stock is currently trading at 1,262 yen. So a bit about the company then in terms of what you're actually buying if you were to buy the stock. It's effectively a precision plastic box that holds $750,000 of wafers, is the best way to explain it. And the product is called FOSBI, so short for front opening shipping box. And it's effectively a plastic box, but to be more precise, it's like a precision molded plastic enclosure that then holds around 25 wafers in a sealed particle-free environment. And so, of course, that's where the technical aspects comes in. And it's not just a plastic box. Obviously, we can put wafers in and then ship the wafers to fab manufacturers who then can make semiconductors and chips from that. Of course, with the current AI super cycle we're in, this is a highly, highly important part of the supply chain to make, GPUs, CPUs, and all kinds of chips that we need ever increasingly in this current day and age. So the moat then isn't actually the resin to make the product or the plastic product. The moat is actually the qualification. And what I mean by qualification is effectively brand, reputation, a market perception that you know how to make the product and that you are effectively safe and reliable. And being a Japanese company, I think this comes in already from a qualitative perspective. From already, I guess everyone can kind of trust Japanese to make high quality products. And this company, Miraial, specifically kind of pretty much invented the product and the process in the first place. So they're very highly reputable and trustworthy within the sector. So quickly moving on to the numbers then, I have a quick snapshot of everything. So as I've mentioned before, the share price is trading around 1,262 yen as of the 24th of April. This gives it then a market cap of around 11.4 billion yen, and converting that into US dollars then, so everyone kind of has a good reference point, it's around $70 million. One of the big stories I kind of mentioned earlier then is as a net cash. So obviously all the cash minus the debt of the company, which is nothing, but the net cash position is around $30 million, which then gives it a net cash to market cap percentage around 41%. The price to tangible book ratio or book value is 0.5x. The EV to EBITDA during trough is around 3.3x. So again, you can kind of see with these valuation metrics, it's very cheap. And the company currently gives a stable dividend, which has recently just grown now to 4%. And I've already mentioned the interest-bearing debt is zero, so there's no debt on the balance sheet. So moving more onto the sector then, and the oligopoly I mentioned earlier. So there's three main players once you exclude the more regional Chinese players, and in some other countries there are some again regional suppliers, but in terms of the global markets, realistically there's only three real players and three real companies that are used and trusted. More importantly, as I mentioned, that's the moat really here is the trustworthiness and the qualification that these companies can provide a good product. And the biggest one, of course, is Entegris in the USA. So they're a global scale leader. They have broad contamination control platform and bundles and cross sales. So basically, they don't just make FOSBI, they do loads of other things around this. And so they can do cross sales, bundles, and they're just by far the biggest player within this whole environment. You then have another Japanese company, which is called Shin-Etsu Polymer. And it's a sister company effectively then to Shin-Etsu Chemical, so a much bigger company, much more well-known company. They trade on the main stock exchange in Japan, and again they have very deep customer integration due to the fact that they don't just provide one product or service, which then leads me on to Miraial, and this is actually a pure play focus in that this is all they do. They effectively make a claim then within this specific product that they have world top share, which again, the fact there's three main players kind of makes sense and backs that up. But more importantly for them, their strength is their net cash position, fortress balance sheet, which we've already mentioned. In terms of the weaknesses then for each of these companies, So one thing that's super interesting is the fact that Integris, which operates within this basically similar segment, they have a 31x EV to EBITDA versus, as I've kind of mentioned before, Miraial have one of 3.3. So nearly a 10x difference in the valuation assigned to these companies. Again, Entegris do much more than just the phosphate production, but it's something to keep in mind, and I think is worthy to note is the complete disparity between the valuations investors are providing these two companies, a 10x difference. And then again, with Shin-Etsu, their main weakness is just the fact that they're a very, very diversified company, and the stock has been flat for nearly 20 years. With most, I think, Japanese manufacturing companies have really struggled to have any real stock appreciation, which again will lead us on to one of the catalysts from the Tokyo Stock Exchange and Japanese government of trying to push the valuation metrics for their companies, and I guess the growth perspectives and things like that, which again we'll get into. So I've kind of already gone over these points, but in terms of why the stock is so cheap then, and the caveat is, of course, the honest answer is there's three main points. And it definitely is not, the market's just wrong. The market's been wrong for 8 years now. I think once you get to that length of time, there's definitely some issues and some stuff to be wary of. But again, we're not really even trading these issues in the sense that none of these really affect the thesis here. But it's worth mentioning just so you're aware of. The first one I kind of mentioned before is the listing tier and float. So it does trade on the Tokyo Stock Exchange, the standard market, and not the prime market. And then on top of that, it has treasury adjusted float of around 9 million shares. And effectively what this then means is that for many foreign and domestic funds, they simply cannot invest or own it. They'll move the stock price, and there's just nowhere near enough liquidity for it to be worthwhile. The next point then is the customer and geographic concentration. So around 3 customers make up 41% of the FY26 revenue. So there's huge customer concentration and concentration risk in the fact that if one of these customers were to drop off, the company would take a massive, at least short-term hit to their revenue. And then the Asian skew matters more now in terms of the fact that predominantly they obviously are based in Asia, and most of their customers are also based in Asia. But now, given the fact that China I've already mentioned, kind of formalizing local sourcing and pushing more domestic production of the entire semiconductor supply chain, we're seeing more and more Chinese phosphate suppliers scaling up and entering onto the market. Miraial's international sales is not really much of an issue. I don't think, at least to the short to medium term anyway, because a lot of these Chinese phosphate suppliers are completely focused on the domestic market. And again, like I said, kind of ensuring that domestic supply chain is secure. So they're not really looking outwards as of yet to sell any of their products outside of China. So there's no real issue there. But again, it just kind of hurts the growth and the fact that there's such a massive, Asian market that they're losing any access to. And so that's one of the big explanations for why the valuation multiples are so low. And then the final point then is the severe operating leverage. So I kind of mentioned the company's now kind of had a trough due to the demand for these phosphate products declining, again, because a lot of the fab manufacturers have stockpiled on wafers. And so the FY26 revenue dropped 10%, but then the operating profit dropped 60% in the last year. So you can kind of see this massive operating leverage, which of course works both ways. So if revenue was to increase, you are likely to see a massive increase in operating profit also, far greater than the increase in revenue. But of course, when the company is in the trough period like it is now, you're going to see the opposite or the negative side of that. And that's another reason why the stock price and the stock hasn't been performing very well. But coming on to the positives then, and personally why I'm investing in this company, the biggest reason is the risk to reward ratio, and not because the reward is going to be a 2x, 5x, or even a 10x, bagger stock, but it's actually the fact that I believe anyway, the risk is so low that the risk to reward aspect of this trade is quite attractive. And then the reason for that is then the downside math is genuinely hard to break, and the floor for the stock can only really be broken if one of two things happen, and that is management effectively wastes cash on bad M&A deals, or the fact that the wafer carrier business structurally becomes impaired. I think the latter is pretty much extremely very unlikely, and then wasting cash on bad M&A is slightly more likely and possible. We have seen a recent M&A deal but the M&A deal has been very, very small. And again, the reason for it has actually been due to one of the catalysts we'll mention, but a push to increase the valuation multiples of the company and kind of expand and grow the company, which again, they've not had much growth in terms of revenue and earnings the last basically decade. But so yeah, if they were to keep, I guess, doing M&A deals and buying bad companies or doing bad deals and wasting that cash, then of course the floor would then increase and the downside risk would increase. But as of now, I kind of mentioned they have 41% of cash, or 41% of the market cap in cash, given then enterprise value around 6.7 billion yen. And effectively then what that means then is a 13 to 17% downside, and anything below that, the company would then trade for less than its cash plus a 4x trough EBIT, which at that point we're very, very likely to see an activist or buyer just take it private, because from a fundamental business perspective, the company just becomes so cheap. And again, a company that operates in an oligopoly that's profitable, has a very good reputation and branding, becomes just so cheap, it's very, very likely, I believe anyway, that we see an activist kind of just basically buy the company up for hopefully a decent premium on the current share price it trades. So there's two main catalysts then. Catalyst number one, the Tokyo Stock Exchange governance mandate to push price to book ratio above 1x. So in 2023, the TSE formally instructed every listed company trading below book value to publish concrete plans to raise their price to book ratio above 1x. And as of today, then the company's trading at 0.5x. And so of course that was in 2023. And then finally now, just in their 2026 strategy presentation that they just released, we finally seen mention of their plans and goals to constantly have a price to book ratio above 1x, and they've kind of outlined how they plan to achieve that. And if they were to achieve that, again, you can kind of mechanically see very easily here by the numbers, but the stock price would effectively double before any earnings recovery was to even be priced in or set in place, right? So if earnings and the financial performance of the company was just to stay the same, but then the valuation multiple applied to the company was to double, then the stock price doubles. And for me personally, this is like the biggest and most important catalyst, and the main reason why I personally am buying the stock, alongside the fact that it has a fantastic balance sheet and strong fundamentals in terms of management and again the branding and reputation of the company. But the main catalyst in terms of what I believe can push the stock price after nearly a decade of doing pretty much nothing and halving in the last 8 years is the fact that there's this real governance catalyst and push by the Japanese government and the Tokyo Stock Exchange to increase the valuation multiples of their companies. And now finally, after I guess 2-3 years, the management themselves have now come out and laid out a plan on how they, I guess, believe they can achieve this. And yeah, so that's effectively what we're playing here. So then leading on to then the catalyst number 2, which kind of feeds off catalyst number 1, is the fact of buybacks. So the cash is already there. We've already mentioned the $4.7 billion in 4.7 billion yen. And when you, I guess, combine such a large cash balance relative to the valuation of the company with a push to increase valuation multiples, buybacks is one of the easiest and most logical options that management have. So you kind of see, I've mentioned here, they have about 1.082 million in treasury shares held, of which 10 million have been issued and already retired early. So around 9 million have already been retired. There's already a historic precedence for this to happen. And so I think it's very, very highly likely we do see a buyback in the near term. I'm kind of forecasting this out then. So just a 1.5 billion buyback would be around 32% of the cash they currently have, and deploying that then would actually retire 12% of the float. And then effectively what that means then is there'll be 12% less shares, of course, in issue. And then from a pure mechanical EPS perspective, this of course would then drive the EPS of the EPS for the company up, not because again earnings are increasing, but the fact that per share there's less shares, right? And so then each remaining share after that point then receives a larger portion of the earnings of the company, making each share then of course worth more. So you kind of see mechanically how it works, where again the actual business or fundamentals of the business doesn't actually need to improve much. All we really need to see is the cash be used effectively that they have on hand. So I've already mentioned the risk reward then, but effectively the downside can be anywhere between 5 to 17% versus an upside then of anywhere between 35 to 100%. So you can kind of see the massive disparity between the downside and the upside. And then on top of all of that, while we wait for, again, a mechanical thesis to play out in terms of just purely doing share buybacks and maybe some good M&A deals, which of course will take time. So anywhere between, again, my estimate is anywhere between 1 to 3 years. But while you hold the stock for 1 to 3 years, you're not really being punished in terms of opportunity cost, at least from the perspective that there's a 4% dividend being paid. So if you were to, again, park the cash in a savings account or high yield savings account, for instance, you're likely to get 3 to 4% anyway. So you're not losing on that. And then on top of that, the downside really is minimal, while you're kind of being exposed to an upside of, I guess, maximum about 2x. But at the very least, maybe 50%, right? So you kind of see this scenario here where we have a gradual margin recovery. So again, the company has been in a trough period. So we see that improve because, again, it's very cyclical, the business. So we see that improve. We have a modest buyback executed. So not even one that I'm forecasting to occur, but a modest one. And then from that, we can very easily see the price to book ratio kind of drift towards around 0.7x. What I'm watching then, so there's 4 signals that I think you need to be wary of and keep an eye on. As already mentioned, the buyback announcement or treasury share cancellation. So either one can occur. And this, of course, is the cleanest, sharpest catalyst available. Datable, surgical, mechanical. You kind of get the point. There's also the activist aspect I've mentioned. If the stock price doesn't appreciate while all this occurs, then it's very, very likely the company just gets bought out, either by an activist who then pushes management to do more growth, I guess, activities, or just take the company private. And again, usually when the company gets taken private, we do see, as shareholders, appreciation in the stock price. Because again, to take a company private usually takes paying a premium. So there is that. And then finally, kind of downside risk for the sector and the company specifically is the Chinese customer order trends, likely to kind of... So final slide then, to summarize everything up, you don't need a growth story here to win on this one. This isn't a growth play like most long thesis or analysis within the semiconductor space. This purely is a deep value play where 3 things are effectively happening simultaneously. That being the company is genuinely cheap at 0.5 price to book ratio with 41% cash. So it's not a discount story, it's just an accounting fact. There then is the second point of being genuinely flawed, i.e. the downside is minimal, and there's also activist buyout kind of maths playing in. So even if the stock was to drop another 10-20%, at that point it's very unlikely that we don't see an activist come in and buy the company up. And then the final point then is there are credible catalysts, 2 specifically, the main point being that the Tokyo Stock Exchange governance ratchet and the push for a lot of these Japanese companies to increase their valuation multiples to at least 1x. And then kind of attached to that then, alongside the strong balance sheet, we're very, very likely to see buybacks, which of course then will lead to the stock appreciation. So that's kind of the thesis and the analysis here. Very, very mechanical, I guess, and not based on not really based on qualitative aspects of business and microeconomics, but rather, I guess, accounting facts and stock exchange mechanics, right? So I think I'll leave the video there. Of course, if you do have any questions, as always, do leave them down below in the comments. Otherwise, until next time.